All right, thank you. It's February 26th, and this is a meeting of the Board Finance Committee for East Bay Regional Park District. Pursuant to Governor Newsom's Executive Order number 29-20 and the Alameda County Health Officer's current shelter-in-place order, effective last May, the Park District headquarters will not be open to the public, and the Board Finance Committee and staff will be participating via video conferencing. So if there are people who would like to participate and view and possibly make public comments, we ask that you contact Caitlin Stone, and you should go to her email, cstone@ebparks.org, or call at 510-544-2400, and she will guide you to the meeting and to participating if you are interested. We have public comments at the end of our agenda today. So with that, CFO Deborah Ocker, do you want to introduce the first item? Oh, well, maybe we should, you want to introduce, I'll introduce myself. I'm Beverly Lane. I'm the chair of the Finance Committee. I'm on the board of directors. And with us, we have Elizabeth Eccles, who represents Ward 1. And we will have a third member joining us in a little while. So then, Deborah, would you like to introduce the people who are here from staff and then introduce the first item?
Yes, thank you, Director Lane. I'm Deborah Ocker, the CFO of the Park District. And with us today, we have Assistant Finance Officer Deb Spalding, Assistant Finance Officer Michelle Strassen-O'Hara. You've met Caitlin Stone, our recording secretary. We also have David Sumner, our audit manager, Kim Belingit, our accounting manager, Tao I'm going to say your name wrong again. Tao is with our budget unit, our admin analyst. And then we have some other staff from other departments. We have Ren Bates, capital projects manager, Ruth Tumber, management analyst from operations. And with that, we'll go ahead and get started with our first item on the agenda. Deborah Spalding is going to introduce our quarterly investment report. Thank you.
Hi, good afternoon, everyone. I'm Deborah Spalding, Assistant Finance Officer. And as Deborah said, I'm going to present to you the Q4 investment report. And I will do a brief review for those of you who have the packet in front of you of the information that's on page 5. It's an Excel chart. And after I do my brief review, I will turn it over to PFM, who are investment consultants. And they're going to give much more detail about the current investment environment, as well as our ESG strategy. So starting out with the table on page 5 of the packet, up at the very top, we talk about our liquidity portfolio. So these are the funds that we have readily convertible to cash. And if you compare where we were in December 31st as where we were at the end of the third quarter, September 30th, you see a big jump up in our pooled cash, and that is related to the receipt of property taxes, which always come in at the very end of December. And so those funds go into pooled cash accounts, and then we slowly invest them over time, but right now, or we spend them, but right now at December 31st, they're sitting in pooled cash. And then I just have a few bullet points in there talking about the yield on some of our pooled cash funds. So LAIF, which has the majority of our pooled cash, had a yield of about 0.5% as of December 31st. CAMP, quite a bit lower at 0.1%. And then our Bank of the West sweep account, sometime at the end of last year, we got a notification that the yield on that account is going to be 0%. And that's where we keep our money that we're using for the day-to-day, payroll and paying invoices. So just to give you that sense of really low investment returns in our pooled cash accounts. And moving on to a little further, oops, too far. A little further down on that page 5, we explain the short, mid, and long-term securities. So just a little bit to highlight here. One is increased holdings of state and local agencies. And conversely, we've reduced our exposure to US Treasuries. And that's more visible if you look back at a year ago. So that column that says market value at December 31st, 2019, you can really see the change there. And then if you look at the bottom of this table, you can see that we've actually added some securities that are even longer term than we've had before, so beyond 5 years. And that is, again, an attempt to safely increase yield on our portfolio. The short-term stuff I was showing you has very, very low yields, but if we go out a little bit further, longer-term investments, we can get a better return. And then lastly, just talking about district funds held in trust, I highlighted our Measure WW project funds, and we are continuing to draw down on those as we continue to implement our projects. We're able to get reimbursed from the trustee for those costs. So we're using up those WW funds, and our plan is to do the next debt issuance in the late fall of this year. Lastly, just a brief summary of our environmental social governance score. So that's ESG. We are at the medium risk level still. We did do a slight improvement in our score, our ESG score in Q4, and you'll hear much more about this from PFM. Approximately 62% of the district securities are rated, have an ESG rating. So US Treasuries and municipal bonds do not have ESG scores. So at this point, I'm gonna stop sharing my slides and PFM will share their slides.
Thank you, Deb. Allison County is going to start sharing the slide deck for us in just a moment. And as we typically do at this meeting, we will start by speaking about the market environment, just a little bit about the economy, before we move forward to the specifics of the district's portfolio and the strategy we implemented during the 4th calendar quarter of the year. We'll then go on to the ESG report. We have with us David Reeser, who's presented to this committee before, and he'll speak specifically about our ESG strategy. And then Allison will continue with some of our outlook. So I'm going to invite Allison to start by speaking about the market. Thanks, Allison.
All right, thanks, Monique, and thank you, Deb. And good afternoon, everybody. As Monique said, I'll go ahead and get started with a brief market update. Please feel free to jump in with questions, or you can hold them to the end, whatever works best for you. But don't feel bad interrupting me, as I can have a tendency to get going once I get going. So I'll start off here with just an overview of some major themes here that were really present during the 4th quarter of the year. And it's not surprising now the coronavirus is the first thing on that list there. It, of course, continues as it has for most of 2020, have a major impact on all of our personal lives, health, and then also the economy. And during the 4th quarter, we did see a resurgence in the virus, as expected, but still, nonetheless, it was unfortunate. At the same time, we saw the initial approval and distribution of vaccines. So that was a very good thing. As we move into 2021, we continue to see those vaccination distribution ramp up. And so that, like I said, is very great to see. But the resurgence of the virus during the 4th quarter did have an impact on the economic recovery. And we saw a little bit of a slowdown in the recovery, which we'll talk a little bit more about. As we look at the recovery, especially moving into 2021, it's really expected that businesses, but especially consumers, are really going to drive the recovery. Consumers, individuals, households who have, kept their jobs throughout this, who have been able to work from home or work in an industry, where you continue to work, have done quite well financially. In addition to, home values moving higher, people are saving money. Some additional money due to the stimulus checks, but not going out to eat at restaurants, not going on vacations, not taking trips has really led to an increase in the amount of savings. And so it's expected, as the vaccines continue to roll out, when we can get back to a more, normal life, that the consumers will really come back strong with all that pent-up demand. I touched on it, but the impact of the pandemic has not been felt evenly, and there are a lot of people who are still struggling due to not working, maybe because they lost their job or they had to choose to stop working because of having children at home, and that impact, how it's been felt, has really depended on your socioeconomic status or your job type, race, as well as gender, and so there do continue to be people struggling. And because of that, we continue to see additional stimulus measures put into place. In terms of the markets rally, kind of speaking to stock markets where we do not invest the district funds, but stock markets really did quite well in 2020 after a sharp drop early in the year. The S&P returned 18%. In the terms of the bond markets where we do invest the district funds, high quality bonds, the bond market interest rates stayed extremely low throughout 2020. As we talked at prior meetings, the Federal Reserve cut their Fed funds target rate down to 0 back in March, and really interest rates on the shorter end, especially 3 years and under, have not moved. We will see longer term interest rates have started to move up a little bit, but all in all, interest rates have remained quite low. And then I mentioned stimulus. Stimulus packages that were passed, we had one passed in December, another one looks like it's on the way. That has also supported the markets and economic growth. So on the next page here, just a few different economic indicator charts here, kind of highlighting that slowdown that I mentioned. So I'll just briefly touch on these. In the upper left-hand corner, we have consumer confidence over the past couple of years. You can see that sharp drop early in 2020 and kind of starting to feel a little better in the fall, but then at the very right side of the chart, again, a dip in confidence. Again, as that increase in coronavirus cases really took a hit to people's confidence, to small business optimism. And so what that translates to is less spending. People aren't as confident that maybe they'll keep their job. And so they're just less likely to go out and spend or invest when their confidence falls. And you can see that reflected in the retail sales number on the right-hand side. Retail sales at the end of the year was quite dismal. You can see there kind of negative numbers there for the last 3 months of the year. However, the January, the first month of 2021, saw very good sales, about 5% month over month in retail sales. So a good bounce back from that slowdown at the end of 2020. On the left-hand side, lower left, you can see the unemployment rate. The employment sector is another sector where we've seen a bit of a slowdown, a sharp recovery initially, moving from that high of almost 15% unemployment rate in April. We have dropped pretty sharply since then, down to 6.7% at year end. However, you can see looking at the last few bars there on the chart, we've kind of been stuck at around that 6%. January, it moved down to 6.3%, but still hovering, well above full employment, well above where we were pre-pandemic. And then finally on this page, new home sales. You can see, like a lot of the other charts, home sales took a dip at the end of 2020. However, housing market has been extremely strong throughout this time. And so a small dip isn't really too much of a concern here, but we did see a small decline there in new home sales at the end of the year. I mentioned that Congress passed that stimulus package in December. So we're just summarizing it here with a $900 billion relief package. The pie chart there, I'm showing what all the funds were spent on. The biggest portion going to small businesses, those paycheck protection programs, the loans, to help people stay employed during this time. There's also a piece to direct checks. Many individuals received $600 checks with this stimulus package. Additional unemployment benefits. A lot of the unemployment benefits that were passed with one of the initial stimulus packages earlier in 2020 expired at the year end. So that extends some of those benefits to people who have been unemployed for a long period of time, who normally would no longer be eligible, and also for people who would not normally be eligible due to their job type, such as self-employed or gig workers. So unemployment benefits for those people. Schools receive funding, directed toward the coronavirus, testing, tracing, and vaccines. The transportation sector, including airlines, as well as state and local government, county, large transportation agencies, and then some other funds, including support for small banks that serve low-income and minority communities, and childcare and broadband services. So a pretty diverse package there. It didn't cover everything some people wanted to see, and part of that is, and so that's part of the reason why we're seeing another package going through Congress right now, a $1.9 trillion stimulus package. Looks like it's probably going to be approved here pretty soon to address some of these same things, as well as other pieces that were not addressed by this stimulus package. So now turning to interest rates. So the chart here on the left-hand side shows the U.S. Treasury yield curve at 3 points in time. The yellow line is December 31st, 2019. The dotted blue line is September 30, 2020, and the solid blue line is December 31st. So the blue lines show you what happened quarter over quarter for this fourth quarter of the year. And then the yellow to solid blue is what happened in 2020. So that sharp drop in interest rates, you probably recall, occurred in March. The Fed cut their Fed funds target rate in March. Interest rates fell across the yield curve, and they pretty much stayed there, especially on the very short end. You can see looking at 3 years and under, interest rates didn't move quarter over quarter. Interest rates there haven't really moved since March. They've really been stuck at zero because of the Fed rate at zero. On the longer end, though, beyond 3 years, we are starting to see interest rates move higher, a little bit in that 5-year area, even more so. Like the 10-year is closer to around 1.5% today, and the 30-year, if you don't show here, moving up as well. Those longer-term interest rates moving up higher on the likelihood that we will see pretty good economic growth here in 2021, also with that additional stimulus. And then also on some expectation that we might see a pickup in inflation in the coming years. And so long-term rates move up higher in response to that. As Deb mentioned, and we'll see later, we have started buying a small allocation, but nonetheless an allocation to some longer-term securities beyond that 5-year range. And so that's allowed the district to take advantage of some of those higher yielding investments. And then the chart on the right is just the 3-year U.S. Treasury going back over the past 5 years. So you can just get a little more perspective on what interest rates have done recently. And again, you can see focusing on the right-hand side of the chart, that sharp drop there in March, and then pretty much flat since then, flat and near zero. So the next page here is kind of an outlook. According to the Federal Reserve, the Fed released these economic projections in December. I'm showing here for GDP as well as the unemployment rate. So on the left-hand side, GDP for 2020, this shows a projection, but it's actually come in now at minus 3.5%. So a pretty big decline there in 2020 as was expected. But you can see the Fed projects that 2021 will see a very strong growth in the U.S. economy of just over 4%. And really that's because the Fed, as most people are expecting, that will kind of be able to maybe get back to normal here in 2021 as the vaccine rollout continues, as more and more people are vaccinated. I mentioned consumers, a large amount of consumers have money saved up, they're ready to spend, they're ready to help the U.S. economy grow. And so the Fed does expect strong growth in 2021. And then the subsequent years kind of back down to that where we've seen, 2.5% growth or so in GDP. And then the right-hand side shows you the unemployment rate. So we ended the year with an unemployment rate of 6.7%. You can see the Fed's projection for the next couple of years. So they do expect the unemployment rate to continue to move lower, but to stay relatively high. If you recall, we had unemployment below 4% earlier in 2020. And so they're projecting it will take several years before we get back to that level. As of now, there still are about 10 million people who were employed before the pandemic hit. So there's still a lot of room to make up in the job market. A lot of people who still aren't working who want to be working. And so that's the last page of the economic update. And I'll move into the portfolio review. So page 15, just summarizing, the strategy in the portfolio during the quarter. We continue to maintain broad diversification, and that's diversification among sectors, which we'll see here, but also maturity and issuer. Diversification historically has really benefited the portfolio, and as we'll see when we look at performance, it was very beneficial to the portfolio over the past quarter and the past year. We continue to maintain a very high credit quality portfolio. That safety is the #1 objective, and the portfolio does have a high credit quality reflecting that. And then we did continue to seek opportunities to safely add value. Purchases were really diversified among all the permitted sectors, but there were certain areas where we found more value, and we'll take a closer look at that in a couple pages. We continue to maintain laddered maturities. The portfolio is managed according to a 1 to 3 year strategy. So a bulk of the investments are in that really 0 to 3 year area. And we continue to invest in that area also a bit longer, but really well laddered across the maturity range. We continue to manage the portfolio to be even with the benchmark in terms of duration or average maturity for a couple of reasons. One, we do expect interest rates to remain low because the Fed is telling us that interest rates will remain low, but there's also a lot of uncertainty. And in that kind of environment, having that neutral duration position is where we think is appropriate, and then we will look to add value through sector selection to help the portfolio outperform the benchmark. And then, of course, we continue to carefully manage risk. Safety is always the first objective. It's what we put first in all our decisions, but that was especially true in 2020 with so much uncertainty, with the special circumstances regarding the coronavirus and its impact on the economy. We continue to really monitor and review all the issuers in the district's portfolio and on our approved issuer list. And again, we're recognizing challenges that we continue to face, that the economy continues to face, as recovery has been quite uneven and also decelerating a little bit. So here we have the portfolio at year end by sector. You can see the market value, the percent of the portfolio, the change in the allocation over the prior quarter end, and then what's allowed by your policy. So the portfolio was in compliance with your policy and California government code on a sector basis. You can see there's about $138 million invested in those longer term securities, in individual securities. And then on this page, we do also show the CAMP portion of the district funds, about $53 million in CAMP. As Deb showed, the district has a few different liquid accounts. So CAMP, like LAIF, is available overnight, but we show CAMP here because it's under PFM's management as well. And so then just briefly touching on the change over quarter. So your cash balance did increase a fair amount, and so that kind of makes it a little more difficult to see what was done in the portfolio in terms of the buying or selling of securities. But I'll still touch on that here. So as Deb also mentioned, we have the municipal allocation, the municipal obligation allocation has increased in the portfolio over the past year as well as over the past quarter. That has been one sector that has offered a lot of value, especially in the latter half of 2020. It's offered good diversification for the portfolio and pretty attractive interest rates relative to U.S. Treasury securities. Also, you can't see here, but the federal agency sector was increased a little bit quarter over quarter. Those yields have been pretty attractive relative to U.S. Treasuries. They don't offer as much value as they did a couple quarters ago relative to Treasuries, but we still found opportunities there to safely increase interest rates that are in the portfolio. Then I'll turn to the next page and talk a little bit more about the sector allocation as well as the maturity distribution. So here's just a snapshot of the portfolio at year end. I'm giving you a lot of information, so I'll walk through some of it here. So on the left-hand side are some of the portfolio statistics. You can see, the par value, the market value, some of the values we just went over on the prior page, but about $138 million invested in securities, And then again, 50 so million in camp, the total of about 189 million here represented on this page. At year end, the portfolio had an interest rate of 1.43%. So that was essentially the earnings rate on the portfolio at year end. And you can compare that to market rate. So the market rate would be if this portfolio was purchased on December 31st, 2020, all the same securities, it would have had a yield of 0.48%. So you can see how interest rates have fallen so much over the recent time period. Also, if you recall, Deb talked about the rates on those really liquid accounts, on the LACE and CAMP account, those earning less than 1%. As we saw a few pages back, very short-term interest rates are basically at 0%. The Fed has their target rate at 0%, so short-term rates are at 0%. This portfolio of securities has been able to maintain this higher yield, 1.43%, because of its longer duration strategy. Here you see the maturity distribution of the portfolio. Again, most of the securities there between 0 and 3 years because it is a 1 to 3 year strategy. And so having those longer securities really helps the portfolio maintain that higher yield. And also you can see there some of the longer durations, in that 3 to 4, 4 to 5, and then about 1% beyond 5 years. So even though the portfolio has some longer maturity securities, we do continue to manage the average maturity or average duration to be in line with your benchmark. So you can see here the average effective duration at 1.8 years. So even though you might have some longer maturities, we're really targeting that average to be right in line with your benchmark. You can see here from the credit quality chart, the chart is a very high credit quality. Over 2/3 of the portfolio rated AA or better. This brown category here is your AA, then you have your AAA. So a very high credit quality portfolio, everything in compliance with your policy and code. The right-hand side, again, the sector allocation of the portfolio just as a pie chart. But you can see it's a very colorful chart. The portfolio is very well diversified among the different sectors. And this, we think, really benefits the portfolio. It increases the safety of the portfolio, and especially when you look at the credit sectors, asset-backed, negotiable CDs, corporate notes, those sectors that have credit risk, they make up relatively, not very large portions of the portfolio. And beyond that, which you can't see here, it's very diversified by issuer. In those credit sectors, issuers are no more than 5% of the portfolio, but typically closer to 1% of the portfolio, just thereby, increasing the overall safety of the portfolio. The diversification also really benefits performance. There's no one quarter, 1 year where one sector always outperforms. And so by having that diversification, that really helps to have more well-rounded performance that we'll see typically outperforms your benchmark. So speaking of performance, here we have it on the next page. So we show the portfolio's performance, the top line here, and then the blue bars on the chart versus your benchmark performance and the brown bars on the chart. And as noted in the footnote, the benchmark is the 1 to 3 year U.S. Treasury Index. The benchmark was quite a few years ago now, the 1 year U.S. Treasury Index. So at the start of the engagement, an index is chosen. The index is based on the district's, risk and return expectations. What return are you hoping to get on the portfolio relative to the risk you're willing to take? And when it comes to risk, what we mean more than credit risk is interest rate risk. The longer the duration the portfolio is, the longer the benchmark is, you have more volatility in returns. And so initially a 1 year benchmark was chosen, and that was extended to the 1 to 3 year benchmark is what we're showing here. So you can see for the past quarter, for the quarter ended 12/31, the portfolio returned 0.19% versus the benchmark return of 0.05%. So very good performance for the portfolio relative to your market benchmark, outperformance of 14 basis points. And that's really because of the diversification. For the fourth quarter of the year, credit instruments like corporate notes, even federal agencies outperformed treasuries. Everything did better than treasuries for the quarter. And so the portfolio did very well relative to your benchmark. And then for the past year, the portfolio had a very strong return of almost 3.5%, again, outperforming your benchmark. Going forward, we do expect returns to be more like we saw here in quarter ended 12/31. So a one-year return of 3.5% probably won't be likely in 2020. It'll likely be closer to 1% or maybe even less than 1%. And that's because interest rates are so low. So we're starting from a very low interest rate environment, and we expect interest rates to remain low. So the two components of total return, your realized earnings, as well as your unrealized gains or losses, both of those components will be quite small. But that said, we will continue to outperform your benchmark through the portfolio diversification and PFM's active management of the portfolio. Just finally, before I turn the page, just looking at the since inception number. So the portfolio continues to do very well since inception relative to your benchmark, earning about 1.5% per year on average.
Thank you,
So
Allison.
now we'll turn, oh, yeah, go ahead.
I just wanted to note, before we turn to the ESG review section, which Dave Reeser will lead on our behalf, I just wanted to check if there were any questions about the strategy and the economy.
Yeah, Elizabeth, do you have any questions on this?
No, I'm good, thanks.
Okay,
Good so far.
And we did have, Allison, we did receive all of these materials beforehand.
All right, great.
Great.
Thanks, Dave. Dave will lead us off in our ESG review. Dave.
Good afternoon, everyone, and happy Friday. Hope you're all doing well. So I'll spend a few minutes talking about, I think there's maybe 4 or 5 slides in here on the ESG aspects of the district's portfolio. As Deb mentioned at the beginning of our discussion, I'm just looking at the chart in the top right corner of the page. We do have ESG metrics on pretty much all of the issuers that are in the portfolio, with the exception of U.S. Treasuries and municipal bonds. That represents about 62% of the portfolio with an ESG assessment, or about $85.7 million. And you can see in the bottom right chart, the sector allocation chart, which sectors, the ones shaded in green, are the ESG rated sectors. So as Deb mentioned at the beginning of our discussion on the portfolio, the portfolio's ESG risk rating slightly declined during the quarter. The average risk rating from a quantitative perspective was 24.1 as of 12/31/2020. That puts the portfolio in what is the medium ESG risk range based on the Sustainalytics scale. Just as a reminder, there are 5 risk categories going from negligible to severe. We see most portfolios fall within the medium to low risk category. So the risk rating slightly improved during the quarter. That was as a result of a number of issues. Several issuers that are held in the portfolio did receive ESG risk rating upgrades, or essentially reductions in their risk rating quarter over quarter. We tend to see many changes to risk ratings in the fourth quarter of the calendar year. I think that's kind of the time frame during which Sustainalytics does most of their annual, kind of deeper dive ESG assessment changes. And most of those changes, I would say, based on my evaluation of the issuers where we saw the biggest changes, were based on a greater or a higher level of dedication and investment in ESG management on behalf of those organizations. So from what I could tell in taking a look at the individual issuer assessments in the portfolio, The majority of those improvements were related to increases in management scores, which is a good thing for the district's portfolio. That indicates that those organizations, management teams, are being more proactive about managing their corporation's specific material ESG risks. And that, again, that is what's largely driving the improvement. We also saw a slight reduction in ESG exposure. Exposure is generally the point at which we start the ESG assessment. You want to kind of first measure the extent to which an issuer or a portfolio, the level, of an issuer or portfolio's ESG risk exposure, and then move to kind of how effectively an issuer is managing that risk. The ratings kind of had a broad range from 8.2, which was for the supranational issuer in the portfolio, which is not surprising because supranationals are, their missions are generally well aligned with kind of ESG principles, so they rate very well from an ESG perspective. To the one issuer, there are actually two issuers in the severe category. The one that's kind of been in the portfolio for some time, National Rural Cooperatives, saw an uptick in their rating to 50.8 from about the 45 level. The issue there with National Rural Cooperatives, quite frankly, is they don't do a very good job of disclosing how they're addressing ESG risks, and they don't seem to be as focused on it. So they kind of get penalized for that in the Sustainalytics methodology. Allison, if you would turn to the next slide, please. Thank you. So on the next page, we can have three additional charts that speak to the ESG assessment of the portfolio as of the end of the third quarter and the fourth quarter. Starting with the table at the top, it provides a high-level summary of the kind of the three key ESG metrics that we look at for the portfolio. As we just discussed, the risk rating slightly improved from 25 to 24.1 quarter over quarter. We also saw slight improvements in the exposure score. That's lower, which is better from an ESG perspective. And we saw a slight increase in the management score, which indicates that management practices are actually improving or strengthening in this area. The chart on your bottom right, the risk contribution by ESG pillar, kind of indicates, kind of provides a breakdown, of the contribution to the average ESG risk rating of the portfolio from each of the three ESG pillars. So the percentages on the outside of the chart, those represent the contributions as of 12/31/2020, and the percentages on the interior of the chart represent the contributions as of the prior quarter end. And you can see there really wasn't any significant change quarter over quarter, slight changes in governance and social, but the portfolio continues to maintain a relatively low level of exposure to environmental risk at 10%. And then of course, the chart on the bottom left provides a breakdown of the ESG risk rating by risk rating category. Again, not significant changes quarter over quarter, slight change in the high and low risk categories as well as the medium risk category, but nothing significant. I think the changes were primarily a function of modest changes to risk ratings quarter over quarter amongst some of the issuers in the portfolio. Allison, next slide, please. So the next two slides provide kind of a couple different perspectives on evaluating the risk rating of the portfolio. On this page, we're kind of looking at it from an industry perspective. So the top part of the page provides the average risk rating by industry as represented by the issuers held in the portfolio as of quarter end. You can kind of see that the aerospace and defense and utilities industries at the highest ESG risk ratings. Now, you need to keep in mind, and you can see this in the charts on the bottom part of the page, In the case of aerospace and defense, that's really just one issuer. General Dynamics, same with utilities, that's really just one issuer. And then amongst the rest of the industries, it's those industries with higher levels of exposure, and in particular our environmental risk exposure, that tend to have higher average ESG risk ratings. And I'm talking about industrial conglomerates and machinery and pharmaceuticals to some extent, as well as autos, whereas issuers which you would think have lower levels of environmental risk exposure and lower exposure scores overall tend to have lower risk overall. This would be software and services and technology, and to some extent financial services. So it's kind of giving you a breakdown by industry, just a different view of the portfolio. Allison, next slide, please. Yeah, and again, this is just another way to look at it. We're providing the risk metrics based on sector type. So as you can see from this page, with the exception of corporate notes and asset-backed securities, every other sector has an average or has a maximum issuer risk rating that is at least below the medium risk threshold. And the average risk rating for each of those sectors is well below the maximum kind of threshold for the medium risk range. So it's a pretty good outcome for the district's portfolio. The district's certainly trending in the right direction. We think over time, as the portfolio turns over, we should see improvements with respect to the ESG risk metrics, but it's going to take time. Several of the issuers that are held in the portfolio now were acquired well before we started implementing ESG. We're certainly not suggesting the district take any action to sell those positions. We don't view them as credit risks. But that being said, I think it's good to sort of keep tabs on them from an ESG perspective, and we will of course do that on a quarterly basis as we talk about this. The next couple of pages just provide additional details on the risk ratings for each of the issuers as of the end of the third quarter versus the end of the fourth quarter. I would be happy to answer any questions that you may have about any of these issuers. I've done some research on some of the bigger movers. If I don't have that answer off the available to me here off the top of my head, I will be happy to look that information up for you. With that, I ask if there are any questions.
Sorry, I turned it off because my cat was talking. Are there any questions of David or Allison on these presentations? And welcome, Director Corbett.
Thank you very much. Apologize for being just a little bit late, but thank you. I'm glad I got a chance to listen to that part of the presentation. I have no questions. I'm just glad to see again, we're always being very cautious and safe. So always glad to hear that. Thank you.
Thank you. So Deborah Ocker, did you have something? Yeah.
Thank you, Director Lane. I don't have a question, but I just, as always, want to thank the PFM team. They have a great way of explaining what's going on in the market, how our portfolio is doing, and explaining the complexities of ESG in a way that we can all absorb it. So I really appreciate all of you being here to share all that information with us. Thank you.
So I do have one question on our page 5, which was the investment balances. But I think, is that Deborah Spalding would respond to that?
Yes, I believe Deborah would.
Okay. So, I look at things going up and down from one year to the other. And I wonder if you would talk again about, it was camp that went down considerably from last year. And then, of course, the US Treasuries. And
Yeah, I'm happy to take that, and I actually think PFM will be able to elaborate on it even more. So,
okay,
starting at as interest rates started to drop, CAMP's investment strategy, as I've heard it explained to me, they go up faster, but they come down faster also in comparison with LAIF. So as the investment earnings on CAMP started to decline, we actively moved our funds into LAIF, which is giving us a slightly better return. LAIF is capped, so we can't invest more than 75 million in the LAIF account, but we still want to have pooled cash available. So we still use CAMP, but the returns on CAMP have not been as good. So we've kind of moved away from CAMP over to LAIF over this past year. You know, as someday, maybe a year or so from now, as we start to see the short-term investment earnings increase, I think we'll see that shift again, where we'll start moving funds out of LAIF and back into CAMP. And as far as the treasuries, and PFM can probably address this in more depth, but this is again like the quickest place that we're seeing our investment earnings drop is in those US Treasuries. And so we've been reducing our exposure there and increasing it in other areas where PFM sees that there's a better value to the district. So I'll stop there and see if anyone wants to add to that from PFM.
Yeah, that's correct, Deb, particularly with regard to the Treasury strategies. Last year, a big component, and it was very valuable to the district, was to have a large portion of the portfolio in the Treasury sector. As the year went on and as interest rates declined, our strategy shifted to seek more income in the markets. As Allison mentioned, a part of your return is income and market value appreciation. And we don't expect to find any market value appreciation this year because interest levels are so low. But we do hope to pick up some income by diversifying out of treasuries into the other sectors allowed in your investment policy, which is why you've seen that decline in treasuries over the last few quarters.
okay, so for both of those, you were watching them and addressing them throughout the year. And in communicating with PFM, Deborah Spalding, are you the one who is the main one that communicate with them?
So we, in our investment policy, we talk about this. We have given PFM the authority to do the investing for the district. We set investment policy, but they make those day-to-day decisions for us within the parameters that we've set. And we have regular meetings with PFM to talk about if they're planning on making a change, or if we want to increase our longer-term investments, for example. We'll talk that through with them, but the day-to-day decisions are made by PFM.
Oh, yes, I would assume that. This is the first time I've been on finance for a while, so I'm asking a little backup questions here too. Okay, thank you very much for that. All right, so is there anything else that we need to know about in this item before I ask for a motion? Since we have a recommendation, we need to send a recommendation to the board on this, correct?
I'm just going to share my screen. I've got a slide on this again.
Okay, well, look at that.
Here we go.
All right, so Elizabeth and Ellen, if you have no other questions, I'd entertain a motion.
Oh.
Go ahead, Elizabeth, if you'd like.
Yeah, I'm not seeing anybody.
Okay, I will move that we move this to the board, that we recommend that this be moved to the board for consideration.
Okay, and acceptance. And Elizabeth, are you seconding that?
Director Eccles went dark. I'm not sure if that means that she's having a problem with her technology right now.
Okay, so she did not have any questions along the way, so I think I will second it. And
And we can just ask her to add when she comes back, maybe?
we could do that, but let's just go ahead with this right now. So all in favor, say aye.
Aye.
Aye. Okay, then the two of us are sending it off, and I'll check with Elizabeth when she comes back. All right. So our next item is number 2, job order contracting program. This is, I think, our annual update.
We do a quarterly update of our job order contracting program, and we have Christina Kelchner and Lisa Gorgian have joined us along with Ren from ASD, and they'll be presenting.
All right, thank you.
Thank you, Deborah. And so I'll kick this off. So good afternoon, Lisa Gorgian, Chief of Design and Construction. And I'm here with Ren, the Capital Program Manager. So we'll be giving the presentation this afternoon.
Okay.
Since this is the first time this item is coming to you this year, I wanted to take a moment to explain why we're here. The job order contracting program, and we call it JOC, the program procedures specifically identify that the Board Finance Committee is to receive a quarterly report on the JOC program, and that the report will include the park the project is occurring in, the project name, phase of work, the approved project cost, the JOC consultant the JOC consultant cost, so Gordian Group is our consultant for this, and the cumulative dollar amount of these orders. All of this information has been provided to you in the staff report, but today Ren will be going over it with photos to better describe the work. A lot has been done, and we know pictures say 1,000 words, so we hope you'll enjoy that. Before Ren gets started, though, I did want to provide an update to another JOC effort that is underway. The JOC policy requires that annually the Design and Construction Department will verify the accuracy of a sample of the labor, material, and equipment unit prices reported in the construction task catalog, and verify unit prices of a sample of those items in the task catalog on a selective basis. And that's out of the policy. Now that this round of JOC projects is almost concluded, we worked with the team from MAST and Financial Management Services. Those are the 2 other departments, and including DECO, that regularly utilize the JOC program to identify 3 projects that generally represent the different categories of the contracts, including engineering, building, and paving. And we've requested written proposals by cost estimating firms to verify that a sampling of the costs is in line with market rates. So essentially, we're verifying that this program is working as it's intended for the district. So the proposals are due next week, and so we anticipate providing an update on that audit and this process later in the year. So we'll be coming back. So unless there's any questions on that part, I'll turn it over to Ren, and he gets to go over the fun part.
I do have a quick question on that. Is that okay, Madam Chair?
Yes, please.
So, so those numbers will be available next week, you're saying?
No, the proposals. So we've requested written proposals in accordance with the board operating guidelines. It's for consultant work.
Yes, but the sampling of the costs that we do, I'm just wondering when those numbers will be available.
Well, we have to hire the consultant. Right. Yeah. So we'll hire. That's a great question, though. So we'll hire the consultant, and we've identified the projects, and so we're going to be going through and working to identify which costs we think are the most indicators of how we can evaluate how these fit within the market. So
Okay, and those numbers will come back to us so we can compare the catalog to the market cost and all that.
It'll be part of that report. Yeah.
Okay, very good. That's all I wanted to know. Thank you.
Yeah, no, it's a great question. Thank you for having us clarify that.
Thank
Yes,
you very much.
Director Corbett, the first time we did that, we had our internal audit unit, David Sumner, but we did have to contract out because we don't have the expertise in-house to do that kind of internal auditing. And so when we drafted the policy, we made that be an annual part of it, to use an outside consultant to help us with that review.
It'll just be interesting to know whether COVID has impacted materials and other items in the marketplace. So I'll be interested to see what impacts there may be. Can be good or bad, who knows? We'll see. Thank you.
So I have a small follow-up to that. So would that report come back to us as part of the regular quarterly report to finance?
Yeah, I don't see why not. Deborah, do you remember what happened? The first one happened before I was here, so I'm not sure.
The first time we had it reported out as part of our semi-annual internal audit review, but I think it makes more sense to have it part of the JOC item. It will come back to you either way, either through internal audit or through the JOC quarterly reporting. How's that?
Okay. Okay, thank you. All right, so we're going to have pictures telling 1,000 words, huh?
Yes,
Okay.
we hope so. Thank you, Ren Bates, Capital Program Manager. Thank you, Lisa, for that great introduction and recap of the Job Board Contracting Program. So, as Lisa stated, we are in accordance with our Job Order Contracting Procedures. We're here to provide an update on the current contracts. Lisa just provided you the status of the annual update, and I will give a brief synopsis of our proposal for bidding our next round. Next slide, please. So we are wrapping up our current round of contracts. Just as a reminder, we had 3 A licenses. So that means contractors that are general engineering. They do a lot of site work, utilities. We had 3 B licenses. That's a residential or building contractor. They do a lot of renovations to buildings, HVAC systems, things of that nature. We also had 2 A licenses, which were for paving solely. So in other words, we specified that they be engineering contractors, but we specified that those folks do most of the work. Some of these contractors will sub out some of this work because of the profession, but the paving, we make sure that they do self-performance. So in other words, we know that they're doing the work. We've completed quite a bit with this round. We still have 10 projects that are in construction. Those are listed here. This is also in the staff report in your material. The next page that we just went to shows our 22 completed projects. Like, as I said, lots of the work was done. As a reminder, again, also, we set out with the capacity of $1 million on each of these contracts. And we came back to the board during this round to increase 2 contracts to accommodate unexpected work that wasn't in our work plan and emergency repairs, those being at Hayward Marsh and at Contra Loma for the waterproofing. Next slide, please. Now we'll get to the pictures. So one of the projects that was completed was the Black Diamond Mines Arata Barn restoration. This was run through Finance and Management Services. So I don't have all the specifics, but I do know this went very well. They had to replace a few more boards, but the Contra Costa historical, let me find the exact wording, was very happy with how it turned out. So the people the historical planners at Contra Costa County were particularly happy with the finished project, is what I have been told. Next slide, please.
And well, before you move from the barn, because I'm
Sure.
really interested in the barn. So what all was done? The roof and then support for all sides. Is that what this represents?
Correct, yes. And then boards on the exterior were replaced. So you can see there's a lot of newer looking boards here that aren't weathered to that dark.
Yeah.
A lot of those were replaced. And yes, you've described it fairly accurately. They replaced the roof, and to replace the roof, there were structural members that needed to replace. So corner posts and beams across the top. So it was basically a structural project with a roof repair and then the external boards.
Okay, well, because it's much improved.
Yes, it was as I understand, it was
Yeah.
a bit of a challenge at first to figure out how to secure it because you would not want to get up on that roof to put a new roof on until they had secured it structurally.
Okay, thank you very much.
Sure. Next slide, please. Unless there's other questions about that one. The next project was a repaving of the Roddy Golf Course. You can see this new parking lot. It was repaved, and the paving. This is in anticipation of opening up that golf course for public access. I believe that process is still in with planning, so it's not opened yet, but we've made repairs to the parking lot and trails for that time. Next slide, please. This is the Lake Chabot Public Safety Parking and Fencing. This is nearly complete. This project is to provide a secure parking area with electronic gates at public safety at Lake Chabot. So this has been a project that's been long in the making, but it's nearing completion now. And this will include an electronic gate with a keypad that the police officers can then get into secure parking.
May I ask a quick question on this one?
Yes, please.
Thank you. Does this mean that entire parking lot that's across from the public safety building will no longer be available to others besides public safety, since it's been used in the past for park users?
So no, the answer to your question is it will remain open. Part of the process of developing this was that would be the site that would be secured, but it is not. The fencing is now all on the building side of the access road to the service yard. So in other words, that parking lot that is in front of that Nike training classroom is remaining open and will be still utilized by the public. It has not been fenced in. And initial looks at this project were looking at that parking lot, but has been determined not to. And so the existing parking lot has been reconfigured. A couple of parking spaces have been added, and the fencing has been pushed further down towards the other, not the public safety building, but the staff building that's up there.
Yes. Thank you so much. That's very good to hear. Thank you.
Next slide, please. This is the Huckleberry Culvert replacement and creek restoration. This is Mini McCosker, if you will. This was a culvert that was overtopping and was causing erosion on both sides. You can see that the trail it hits at the trail crossing comes at an interesting angle. And so what was there before was backing up and causing problems along the creek. So this was a project in which we just needed to replace the culvert. As I said, I made reference to McCosker, but it is in Huckleberry, which is right up the road. We've used a similar culvert to be open bottom so that it allows fish passage. And additionally, because of the sensitivity of Huckleberry and the site, we did some contract growing for phytophthora-free plants, and they were planted. So this was a successful project.
Yeah, I hiked up there about a couple months ago, and it was really impressive. So it's just right off Pinehurst, almost within walking distance of McCosker, right?
Yes, it is.
If you want to walk on the road.
Yes, if you want to walk on Pinehurst, which we wouldn't suggest, but it is possible.
Yeah. Yeah. Lisa, did you want to add something?
Oh, yes, thank you, Director Lane. I did want to just mention this project also was, so many of our projects are intertwined in ASD. So this project served as the mitigation for our TCP projects. So, all those projects that we do and they have impacts, this project then helped us mitigate for those. So it was a great way for the trail experience to be better, fish passage to be improved, but then also serve this need within the district to have a site to mitigate for our TCP projects.
Yeah, great. Okay.
Thank you for that reminder, Lisa. Next slide, please. This is the Contra Loma Swim Lagoon waterproofing. This was one of the projects that we increased the capacity on the last contracts to provide. It was a safety issue where the waterproofing was coming up. It reduced the contrast. And so luckily we had a swim season to drain this and re-waterproof it. And hopefully this waterproofing will last for 8 to 10 years. And it was a successful project. Next slide, please. Unless there's questions. The Camp Arroyo yurt repair was completed. This was damaged, I believe, in a storm. Finance and Management Services completed this. It was well done. I don't have any specifics, but I can find out more if there are questions.
Well, my question was, how much is a new yurt? You know, because this was almost $90,000 for a fix. How much does a new yurt cost?
I don't know what a new yurt costs, but I can find that out. Deborah,
Okay, I'm just curious.
We can
Okay.
look into that, Director Lane. This was a FEMA project. And so we did have to rebuild it very similar to what had existed before the storms. And we were reimbursed for the majority of that through our FEMA grant.
Okay, was that the 2017 rainstorm?
Correct. We did a lot of work this summer related to the 2017 storms. It took a very long time to get all the approvals from FEMA and the permits. So this summer is when we did a lot of that work.
Okay, thank you.
Thanks, Deborah, for that reminder. Yeah, FEMA does take a long time. 2008 or 10 took almost 10 years to complete some of those projects. Anyway, next slide, please. Finally, this is our last picture. The Del Valle Visitor Center has been completed. This was a few weeks ago, so the exterior and the building is done. They're currently wrapping up the interior and the exhibits. Those were not done with job order contracting. Job order contracting just did the shell and the renovation of the building. So that was complete, but just as an update, as I've heard that the exhibits are now going in and it is readying itself for opening as soon as we are able. And it looks really great from what I haven't seen the exhibits inside yet, but I got a report from Jim Devlin, who was there yesterday, and says it's looking very, very good. Jim Devlin is the district's district's architect.
Really nice.
Oh, it does, doesn't it? Yeah.
Mhm.
I think it's going to be a vast improvement over the tiny little.
So I was looking at my list of phone numbers, which is somewhat out of date. So I've requested a new one already. So who is the supervising naturalist here for Del Valle, Shadow, and Sonowell? Does anybody know offhand?
I do not know who the supervising naturalist is, but I will find out for you and we will get you a new phone list.
Yes, well,
Yes.
I already requested the list, so because I took a look and these were all from last spring, and things change, as you know. Okay, thank you.
You can reach out to Ira Bletz. He would be able to answer that question straight away because he's been our main point of contact for the.
Has he been the main naturalist there for you? Okay, it's looking transformed from the little old ugly building that was there. So it's pretty exciting to have that done for that large campground.
And I just saw that Ruby Tumbers said Ashley Greer is the Sonowell
Grenier.
naturalist. Great. Sorry for mispronouncing her name, but thank you.
Okay, thank you. Thank you, Ruby.
Thank you, Ruby.
Okay.
Next slide. So we are wrapping up our current round of job order contracts. It has been well utilized at the district by DECO, Mass Management Services. Fire's used it once in a while, so there may be opportunities for that in the future, but we are proposing to advertise for our next round of contracts. The board just awarded recently the execution or authorization to execute with our Gordian Group, which is our job order contracting consultant. We did do an RFP process just as background, and so they were the best suited. So we are continuing with them. We are developing construction documents now, and we are intending to bid the same number of contracts as I described earlier. So 3 A's and 3 B's and 2 A's with paving specifically. The one change that we are proposing, and we discussed this at the last Finance Committee meeting, was raising, and I know that the committee members have changed, so I'll raise it again, is that we were proposing to raise, again, based on our experience in this last round, increasing capacity from 1 million to 1.5 million in the contracts. And again, this does not encumber any money. It's just a not to exceed for the contract. And so all project funding has to be in that project. So we're just increasing the capacity so that we have that freeboard, if you will, to address any unknowns and not have to come back to the board for that. And our experience has shown that we can have done, the district has enough work and we can produce enough work that this seems to be about a good limit for us on an annual basis. It gives us a little bit of more room. With that, our presentation is concluded, and I'm happy to field any more questions. As a reminder, this is just an informational item, so there is no action required.
All right, thank you. Elizabeth, are you back?
Yeah, fortunately, I got most of this presentation. I don't know what is going on with my internet today. I apologize. I've shut off every single device in the house except for my daughter's school, and I still am getting thrown out. So there you go. But yeah, I did want to understand a little better what you were just asking about, Ren, about extending the contract amount from 1 million to 1.5 million. So what does that mean exactly? Because you've got all of these different project costs. So is that the overall cap, or what is that? What do you mean? How does that work? Can you, if you
Sure.
can explain the mechanics of that?
Yeah, not a problem. So when we issue a contract, we issue a contract for a certain amount for fees or services. What happens with the job order contracting is that we set up a contract that allows a contractor to give us price based on our construction task catalog, which is what we're auditing now to make sure it's market rate. But what they do is that it's a fixed cost for labor and materials locally. So in setting up our contracts, what it is it provides a not to exceed limit. So in other words, what we're saying is that we're going to give you work that won't exceed $1 million. So that protects the district, saying that we're not going to go past that. So that's the contract, or the limit of the contract. We're not encumbering any money in the district. So in other words, if a project wants to use job order contracting as a procurement method to get a contractor, then we have them price it on the task catalog. And if there are funds in that project, then they can utilize that contractor. So what we've learned in the past rounds is that $1 million. So $1 million is just a limit for a contract. It doesn't guarantee the contractor any work. The contracts are set up, and this is per public contracting code, is that there's a minimum we need to allow or offer to a contractor once we enter into an agreement, and that limit is $50,000 for ours. The district sets that, and that's based on our policies for basically contracting. Anything over $50,000 we have to contract. So that's the minimum. So we're not guaranteeing this contractor any work up to $1 million, but if they prove to be beneficial and we can work with them, which we have had luck to do in our last round, is that we can do up to $1 million of work with that contractor. And that's what the board approves. So is that, before I proceed into $1.5 million, does that make sense?
Yeah, I think that makes sense. And I think I understand where you're going with the 1.5.
Okay.
So,
Great.
okay. So that would come to the board at another point. Is that?
Correct. And so this is alternative procurement, but we do competitively bid it. And so when we bid it, what the contractor bid is an adjustment factor to the construction task catalog costs. So we have a wide range of contractors looking at the costs that they'll all bid. And then what they bid to us and what we award on is that their adjustment factor. So it's a factor that multiplies the costs in the catalog to give them their profit, all of their overhead. So overhead being their administrative costs, their, keeping the lights on at their offices, all of that is their adjustment factor. And we award based on the lowest adjustment factors. So that's how we award it. And then, so yes, when we come back to the board, we'll have bid it, had a mandatory pre-bid meeting, made everyone apply, or they'll competitively bid, and then we will, based on the lowest 3 bids of the adjustment factor, we'll bring that to a board for authorization of award. And that usually, we bid them all at the same time. So we come back to the board to award it will be 8 contracts at the same time, but for 8 separate contractors, if that makes sense.
Yeah. Thank you.
Okay, Lisa, do you want to add to that? And then I see Ellen would like to have a further question, comment.
Yes.
So,
Yeah, I just wanted to add that the projects that we're working on, we've been working with finance to identify them as part of the project budget. So many of Director Eccles, the projects they will either come to the board separately to either transfer and appropriate money into those projects, and then we will utilize and either we'll have a contractor that we specifically did advertise for bid for a certain project, or we will use it's like an on-call contractor. So, or we'll use one of the JOC contracts. So I just want to be clear that we will be coming back to award the JOC contracts to award those, but the projects to either get started on a project, if there's not already a project identified in the project book, we would of course come to the board for those.
Okay, thank you.
yeah, okay, Ellen, yeah.
This is something I've asked before, and I'm only bringing it up because I think it's important for new members of the committee to know. Ren, I think you can answer this question. The JOC process doesn't create any barriers for us to ensure work is done at the Park District by prevailing wage contractors, right?
No, that's correct. We bid, all of our requirements for our regular bidding are the same. And that's part of our construction task catalog as well, is that it's prevailing wage, it's local material costs, and we make sure that in bidding and using this alternative procurement, that all of the methods by which we do our standard design bid build are the same. So prevailing wage and all of those other requirements are the same for the job order contract.
Thank you so much for clarifying that.
Yes, since we have used JOC for grant-funded projects, we have to make sure they're at that highest level that are required by all the granting agencies.
Yes, thank you very much. Just want to make sure everybody knew that.
Yes, and just as this is probably getting into the weeds, but since we talked about a FEMA project, we've also added into our specifications all the federal requirements that are needed so that we can use this if we get FEMA money to do that project, because it allows us to use a contractor in an efficient manner, get them on board, because FEMA takes so long that we then not sure about the money. So it's beneficial in that regard too.
Great, thank you.
Okay, and so I do have one other question, well, first my comment on the barn is I am really glad to see that, and I know that there were different estimates on different improvements to the barn, and at least one of them was talking about $500,000. So I'm happy to see this came in at least 100,000 less. Then I have a question about the Gordian Group. So is their cost generally a certain percentage of the entire project? Is that how you figure this amount?
Yes, that's correct. And it's based on a 5% of the final agreed to price. So the Gordian Group only gets paid on the number of job orders that we issue and give an NTP on. And so their 5% is based on the amount that is the final cost. So we don't pay them for any projects that don't finish, even if so they do work that if it comes to it and we get a cost back and we end up not issuing that work be done because it costs too much, we don't pay the Gordian Group for any of that. They also do work on the front end for construction task catalog that they'll eventually get compensated for, but it is only per that 5%. So we pay them 5% of whatever the work that's complete by the district. So yes.
Okay, all right, that is good to know. All right, so this is an informational item. Are there any other questions or comments that anyone wants to weigh in on, including you, Lisa and Deborah? All right, thank you very much. Appreciate it. And thank you for your work. So our next item is number 3, which is disposal of fixed assets.
Thank you, Director Lane. This is one of our annual items that we bring to the Finance Committee. And we have Kim Blingett, our accounting manager, is going to present for us.
All right.
Kim, you're on mute. So I know you've gotten into your presentation, but go ahead and start over.
Oh. Okay, there we go. Good afternoon, Kim Blingett, Accounting Manager. I'm here today to present to you the 2020 disposal of fixed assets. Under the board operating guidelines, any adjustments to financial records regarding assets with a book value over $25,000 is subject to board review. Oh, thank you for the slide. Each year, the Park District undergoes a physical inventory starting in October. The results are returned to finance. We record the information in the asset module of the district's financial system. On page 75 of your packet, there's a list of disposals by disposal categories and their related book values. In 2020, we had 33 assets sold at auction. The proceeds totaled about $128,000. The Park District uses 2 auctioneers, First Capital out of Vallejo and J.J. Kane in Dixon. Actually, just late 2020, J.J. Kane had acquired First Capital. We have 10 assets that were considered non-auctionable and were either recycled or disposed. We had 1 asset donated to the Westport Volunteer Fire Department. They protect the most remote corners of Mendocino County. The district donated a 4-wheel, 500-gallon tank fire truck designed for rapid deployment to mountainous and rural areas. We also sold 1 asset, a helicopter, which we all know as Eagle 6. It was sold for $535,000 to a private company. Next slide, please. Here I have 2 photos of the, I have 2 photos coming up in the regarding the structures that were destroyed at the Sunol Wilderness Regional Park. Here we have the 10 by 15 foot stucco storage building at Camp Poloni. The first photo is a front view, and then the second one is a top view of the damaged storage building. Any comments? Next slide. Here we have the Rosefield Station. It too is located in the Ohlone area of Sunol, and I have a before and after photo. You can see the damage photo is practically flipped. You can tell by the where the fireplace, the chimney is. It's currently not being used, or was not being used. At one time, stewardship did use it to study the golden eagles. That finally comes to the end of my presentation. I am seeking a recommendation. I was wondering if anyone has any questions with any of the items on the list. Be happy to answer them.
All right, let me see if I can see people. Just a minute. View. All right. So are there any questions for Kim? with regard to this. I did ask about what was this, I guess it was the Rose Field Station, what that was. And the fire went through and took it, didn't it?
Yes, every bit of it.
As well as most of that storage. Okay, so are there any questions? Ellen or Elizabeth have any questions? Ellen, yes.
I don't really have a question. I just say thank you so
Comment.
much for this report. And I would just say it's good to know that surplus property that we no longer can use can help fight fires in another part of the state. So I think we should be very happy that we're contributing to that.
Yeah, I was happy to see that too. I think that particular thing had been talked about at the board at some point.
Correct.
Yes.
Yeah, that's correct. The board took an action to approve that donation last year.
Yes.
Okay. So it's always interesting to see this list of equipment that we have, I will say. And I am glad we were able to sell Eagle 6 to, we at least received some funds for that. So I will entertain a motion.
So moved.
Second.
All right, no other discussion. All in favor, say aye. Aye.
Aye.
All right. Thank you very much, Kim.
Thank you.
Thank you.
And then Director Lane, as a matter of housekeeping, can we just make sure that Director Eccles had a yes vote on the first item? That's when her technology was going in and out.
Yes. Yes. In fact, I was trying to move that item and you guys couldn't hear.
I thought I heard you. I was going, go ahead, Elizabeth.
We were like, well, where is she? Yeah. So, Elizabeth, we could add your vote in favor of that as a recommendation.
Yes.
All right. Is that formal enough? Okay.
Yes, that will do.
All right. Then our next item, I think we voted on that. Yes. So our next item is update on our retirement plans.
All right. Hi, everyone. I'm Deborah Spalding, Assistant Finance Officer again. And yes, this is just an informational item. Briefly, some history and thoughts on our EBRPD retirement plans as we are planning to go out for an RFP for administration services. So first, some history on the plan. This was the retirement plan for all district full-time employees before we joined CalPERS, and that happened in 2001. So prior to that, 2000 and 2001, everybody was in this, what they called the Transamerica Retirement Plan. And today there are 189 retirees and 3 active employees who are still contributing to the plan. Of those 189 retirees, 72 of them have their benefits funded through annuity purchases. And I mention this because we actually looked at doing an RFP for administrative services back in 2012. And at that time, the number of retirees who received their benefits from annuity purchases was a larger percentage of the plan. And what that means is that Transamerica needs to continue administering those payments. And so at that time it was decided, we shouldn't do an RFP. It's just going to be too confusing to have 2 different administrators, one for people who are on annuities and one for who are not. And but now we've actually had a bit of a change of circumstances. There are fewer retirees with annuities, and that's because we stopped purchasing them in 2013. But also we've had some additional, I'd say, problems with administrative services. So last year there were a couple of mistakes made with the COLA, for example. It was applied too early for the sworn plan and too late for the miscellaneous plan. that caused quite a bit of confusion for retirees who then all, proceeded to call the HR staff. And that was just one of many issues that have come up over the last 5 years as Transamerica has been bought and consolidated, and they're now in Cedar Rapids, Iowa, whereas they used to be in California. And so what we really want is to relieve that burden for the HR staff. They have enough going on without having to deal with this plan. We'd like for there to be some improved access to the to information for retirees. So a call center with a better response time and a computer platform that'd be really user-friendly for retirees. We also are at this point where the funded status of the plan is getting close. It may actually already be at 80%, and our actuaries are doing their review of the plan right now. And when we get to that 80% funded status, we're supposed to change our investment strategy to de-risk the plan. And so take more, for example, take more out of the stock market and mutual funds, and more into stable assets. And so this is maybe an opportunity to look at a new investment manager as well. And then lastly, improved access to data. Right now we have to wait for Transamerica to produce any information that we need. And so we'd like to have some way for us to get information when we need it and not have to wait for the month end or the quarter end to get that information. So we are going to invite Transamerica to apply. They have actually gotten better since that COLA mistake was made last year. They've really upped their game, but we'd already made this plan that we're going to do the RFP. So we plan to issue it in early March, and we'll be returning to the Finance Committee and then to the Board of Directors when we have an outcome from that RFP. So again, this is informational only, and we'd be happy to take any questions.
All right, thank you. Deborah, you wanted to add something?
Thank you, Director Lane. Yeah, Deb Spalding mentioned investment advisory services. We actually currently have Milliman as our investment advisors for this retirement plan, and they've been great to work with, but they will also be part of the request for proposal package. They'll have to rebid, and we'll see if there's a need to change our investment advisor services. They've been with us for a very long time, so it's good to just refresh that service as well. So the whole thing with this plan, administrative services, where they're kind of providing those third-party administrator, working directly with the retirees, and the investment advisor.
And again, who is the investment advisor?
It's Milliman. You may recall, they've been our investment advisor again since.
Okay, yes, I see them. They're in here. Okay. All right, thank you for that. So do we have any comments or questions from the board? I'm not seeing any. Yeah, I was here when we made that change, and it was very interesting because the debates within the employees, I mean, they had huge numbers of questions, and it was a major transition for the for us to move to CalPERS. And
I was actually an intern here at that time, and even I, as an intern, remember hearing the debate.
Even you heard, yeah. Okay, so this seems like a very logical step for us to take at this point too. Very good for us to have that information. And when would you think that the results from the RFP will be brought to us? Will it come to us and then go to the board?
I'm going to say June finance. I can't remember if that's where we schedule it, but I think that's right. Deborah, do you recall?
Yeah, our target is the June Finance Committee if we can get through the review process. And okay. It looks like Director Eccles might have had a question.
Not really a question, but I just wanted to thank Deb for the report, and also just say how important it is to have access readily on the website to your financial information so you can make informed decisions. And that's a pretty big mess up too when you're dealing with, when you don't get accurate information about a COLA when you're retiring. So I definitely appreciate you all going out for an RFP, and certainly they can also participate, but it's a good time to refresh.
Yeah, I think so too. All
Ditto.
right. So that concludes our 4 items, and then I need to find out if we have any public comments at this time.
Yes, Chair Lane, we have one public comment, Mr. Abreu.
All right.
Kelly, are you there?
I don't actually see Mr. Abreu on the call. Did he leave any written comments for us, Caitlin?
He contacted me through email earlier during the meeting, but he did not mention the specific comment he wanted to make.
Okay, so you told him he could phone in, or?
Correct.
All right.
So I don't see him on the Zoom. If he does communicate his comments to us through Caitlin, we will forward them on to all the committee members.
All right, I think we'll need to do that. Maybe we were more efficient than he expected us to be. All right, so are there next any committee comments at the end of our meeting here?
Great meeting.
Thanks, everybody.
Great meeting. Yes, Deborah?
Yes, I just wanted to, I always like to look forward, and we are going to skip our March Finance Committee meeting, mainly because our calendar is very full for the board members, and we typically do skip one Finance Committee every year. So we chose March, and we'll be back to you in April.
All right. Thank you for reminding us about that. And I am looking for an organizational chart.
Yes, we will get that to you. I know Connie was working on that, and we will,
Okay.
supposed to put that in your packet, so I apologize. So we'll get that in the mail to you and by email to all 3 of you.
Yeah. So if I can have a hard copy too, what I look at usually.
Yes.
Okay. All right. Anything else from our other members? All right. Then the meeting is adjourned until our April meeting, which will be toward the end of the month.
April 30th, Friday.
April 30th. All right. Okay. Thank you all. Have a wonderful day. It's beautiful out there.
Okay.
Take care, everybody.
Everybody, have a good weekend.